You know that feeling, right? You see a headline about some conflict happening halfway across the world, and you get this little pit in your stomach. But have you ever stopped to wonder if the stock market itself feels that same anxiety? Well, today, we're going to explore that very real, very measurable link between global instability and your money. We're going to break down how a single headline can ripple all the way across the globe and hit your portfolio.
And that's really the billion-dollar question, isn't it? When news breaks about military tensions or political chaos, we all feel like it has to affect the economy. But is that just a gut feeling? Or can we actually use these big global events to predict what the market's going to do next? Well, that's exactly what we're here to figure out.
So let's set the stage here. Think about some of those headlines. A U.S. military intervention in Venezuela, or the ever-present tension between Israel and Iran. These aren't just stories on a newsfeed. For the financial world, they are massive signals that send ripples everywhere and cause investors to second-guess, well, everything.
And hey, don't just take my word for it. This isn't some abstract theory. Research like this study from the University of Pretoria actually confirms it. When uncertainty skyrockets because of these events, investors get spooked. They either slam the brakes on new investments or they start selling off what they already have. And it's that collective reaction, that mass pulling back, that creates a real, tangible dent in stock prices.
Okay, but you might be thinking, how in the world do you measure something as messy and, frankly, chaotic as geopolitical risk? It seems impossible. Well, believe it or not, researchers have found a pretty clever way to turn all those dramatic headlines into cold, hard data we can actually work with.
First, let's just get on the same page with a couple of key terms. When we say the market is getting jumpy or nervous, what we're really talking about is volatility. You can think of it like the market's mood swings. Low volatility, that's a calm, predictable day. High volatility, that means wild, rapid price swings and a much, much riskier playground for investors.
And here's the second piece of the puzzle, geopolitical risk, or GPR for short. This is defined as the risk coming from wars, terrorism, and all those tensions between countries. Now, here's the brilliant part. The way they measure it is by literally counting the number of newspaper articles each month that are talking about these exact topics. It's a surprisingly direct way to put a number on the world's anxiety level.
All right, this is where things get really interesting. The research found something critical. It turns out the market does not react to all bad news the same way. There is a huge difference between the threat of something bad happening and that bad thing actually happening.
And this slide just lays it out so clearly. On one side, you've got threats. Think military buildups, political warnings, nuclear posturing. It's all about the potential for conflict. But on the other side, you have acts. This is the starting gun of a war, a terrorist attack, a major escalation. This is conflict made real. So, which one do you think the market really listens to? And boom, there's your answer. The data is crystal clear. Actual geopolitical acts are a way stronger predictor of stock market volatility than just threats. Sure, all the saber rattling might make some noise, but it's the real, concrete events, the acts, that truly send shockwaves through the financial system and trigger that intense volatility we were talking about. It seems actions really do speak louder than words.
All right, so let's dig into the core findings. Researchers crunched decades of data across 11 different emerging economies to see exactly how this whole relationship plays out in the real world.
So, finding number one, the link is absolutely real. The data shows a clear and predictive relationship. When geopolitical risk goes up, stock market volatility is very likely to follow. This isn't just a random coincidence. You can actually use one to help forecast the other. Now, this next part is super interesting. The initial shock from some big event, that might be over in a day, maybe a week. But the market's nervousness, that high volatility, man, that can stick around for a long time. The study calls it high but mean reverting volatility persistence. It's just a fancy academic way of saying that even after the headlines move on, the market's anxiety can linger, keeping things shaky for a while before they finally settle back down.
And here's where the rubber meets the road. This finding shows just how powerful this whole idea is in practice. When financial analysts actually plug this GPR data, the numbers they get from the news headlines, into their forecasting models, those models get way more accurate. This isn't just an observation. It's a legitimate tool that can make financial predictions better.
So we've waded through the data, we've unpacked the theory, let's pull it all together now. What does this all actually mean? What are the big takeaways for investors, for policymakers, or really for anyone just trying to make sense of this crazy world?
So what does this all mean for you?
Well, first, geopolitical risk isn't just background noise. It's a real, measurable risk that systematically moves the market. Second, and this is the big one, actual acts scream way louder than threats, and knowing this is a powerful tool. Let's go back to those Iran-Israel tensions. When that situation goes from a threat to an act, you could see crude oil prices surge. For an investor, this knowledge is huge because it helps you spot different trends. Downstream companies, the ones that refine fuel, they might see their stocks tumble because their costs just went through the roof. But upstream oil exploration companies, their stocks might actually go up. Same event, totally opposite impacts. And of course, for policymakers, the message is loud and clear. Managing these global risks is absolutely vital for keeping the economy stable.
Which brings us to one last big, thought-provoking question. If we now have the tools to measure this risk, to tell the difference between a threat and an action, what's the next big thing? In a world that is just flooded with headlines, what's the one simmering risk out there that the market is still treating as just a threat when it's just about to become an act?